Good morning and welcome to the annual NAIOP Mid-Year Economic Forecast webinar. Our program today features a panel of this year's NAIOP Award winner brokers. Before we begin, I'd like to acknowledge our program's sustaining sponsor, Brownstein Hyatt Farber Schreck. Let's also recognize the program coordinators, including our program's chair, Brian Dietz, and Vice Chair, Sarah Crute, along with Tom Koyman and Aaron Hepp. And a special thank you and welcome to today's guest moderator, Nicole Ament, who is a shareholder and the Real Estate Department Chair with Brownstein Hyatt Farber Schreck. Nicole, take it away.
Good morning. Thank you all for joining us first thing this morning. We at Brownstein are super excited to be the sponsor of this event. And I'm particularly excited to moderate this because as chair of the Real Estate Department at Brownstein and someone with over 20 years of experience in real estate transactions, we know the importance that our brokers play, the inside knowledge that they have, and all that they can bring to the table. So this year's winners are a great panel. And if you've joined us in the past for this particular presentation, this year will feel a little bit different because we do have a lot to talk about given where we are in the cycle, given all that's facing us. And so we have a lot of questions for them. They're going to talk about their particular industry segment. I'm going to have questions for them, and we encourage you also to pose questions that we can ask of each panelist as we go along. So I'm going to introduce them all at once. They're not going to speak all at once, but I will introduce them in the order in which we will be bringing them up to talk about their particular industry. Oops. Jama, we lost our share screen. So, I'll wait till we get that. Great, thank you, Jama. So, in order of manner in which they will be presenting today, first we have Tim Richey, Vice Chairman of CBRE, who will be talking about capital markets. Next we have Jim Bolt, Vice Chairman of CBRE, who will be talking about the industrial market. Next we have Shane Ozment, Vice Chairman of Newmark Knight Frank. Jordan Robbins, Managing Director, Capital Markets, JLL. They'll both be speaking about multifamily. Then Eric Roth, Senior Vice President of CBRE, will be speaking about the land market. Then Matt DeBartolomeis, First Vice President of CBRE, and Lee Diamond, Senior Vice President of CBRE, who will both be speaking about office, and Dan McGowan, JLL. So first, Tim Richey, you want to join your video here. And we'll let Tim talk about capital markets.
All right. Am I live? Can you hear me? Hello, hello.
Yes.
Okay,
yeah,
good.
We can hear you.
Thanks, everybody. Pleasure to have you join for your 1001st Zoom call. It's been a long last 3 months with a lot of these calls, and surprisingly so, 9 months ago, we sold the Zoom regional headquarter building in the Denver Tech Center. At the time, nobody knew who Zoom was, and guess what? Today, it turns out that was an incredible buy for that investor. Next slide. So there's good news and there's challenging news out there. The COVID curves are bending. They're not bending as quickly as we had predicted. But good news is there's more fiscal and monetary stimulus on the way. It's going to happen. The jobless claims, 70% of the jobless claims right now are temporary jobs, which is great. Corporate America is slowly but surely gearing up for what I would categorize as a tempered restart. In Denver, locally, the oil price decline and concentration of co-working in our market is certainly going to create some headwinds here in the downtown Denver market, but elsewhere we're pretty strong. And finally, on the very positive news, Denver is ranked 4th in terms of the most concentrated market for millennial population in the country. Very good news. Next. This is a big deal. COVID-19 really brought an abrupt end to this cycle. This is a chart that shows the last 6 economic cycles since 1970. Look at where COVID-19 pandemic is in relation to unemployment. It certainly far exceeds what we saw in the great financial crisis and what we saw in the dot-com bubble. So this has been a big deal. Next. This is the flattening of the curve. Bad news is the US is near the top. Good news is we're less than sort of the average for the developed world. But I can tell you countries like South Korea and Germany, I'm on the phone with them every week. They have figured out how to recover quickly, and we will eventually get there. Next. So what do we expect in terms of big picture recovery here? We're going to peak out in the mid-teens in terms of unemployment. And by the end of the year, the CBRE call is to have unemployment at about between 7 and 8% at the end of, so 6 months from now. Next. This is a great chart. Everybody wonders how the various asset classes are performing from an investment standpoint. This is the US REIT index by sector. So good news for Jim Bolt. Industrial is performing extremely well. Prologis was on CNBC this morning with their quarterly earnings. Very strong, almost exceeding pre-COVID performance. Followed by self-storage, the apartments, offices in the middle of the pack. And then at the bottom, in terms of performance, is obviously hotels and retail. Next. People are always asking us, where are the cap rates? Where have they been? They have been declining since about 2010. We've seen a slow, steady decrease and increase in values. Take a look at the right in the shaded area. We expect a significant increase in cap rates for certain asset classes. So in blue is retail, and there will be, and there already has been, little data points, but significant increase in cap rates and decline in pricing. Same with office. Office is that dark green at the bottom. But take a look at sort of the apartment sector, which is the red, and industrial in green. They're having very limited impacts in terms of pricing at the moment. My colleagues will address that a little bit further. Next. Where are sales volumes? So on the far right bar chart here is Q2, Denver commercial asset sales volumes. We are running about 30% compared to Q2 of 2019. And unfortunately for the Richey family, if you take a look at that sort of purple chartreuse color, we had a great Q1 office sales, and Q2 has been very, very quiet. Bottom line, next please. Next slide. Bottom line here to wrap it up. We do see a wider V-shaped recovery coming. I think the second half of this year is going to be choppy. And 2021 from an investment sales standpoint, I think is going to be extraordinarily strong. There is considerable downside risk for the second half of this year, obviously with reoccurring COVID hotspots throughout the country. What's the timeline for recovery by asset class? The current read is industrial should be fully recovered over the next 12 months in terms of values and performance. Same with apartments, potentially. Office is probably a 12 to 24 month recovery window, followed finally by retail and hotel. Long term, the industrial sector, multifamily, probably come out of COVID ahead of where they were. Retail is going to be reinvented as an asset class, an investment class, and office probably ends up staying the course. Over my last 30 years, I've been surprised to see how resilient values have been, and I expect that the capital values will be really resilient over the next 24, 36 months. Thank you.
Thanks so much, Tim. See, I think I want to start with, you talked, that very last statement was capital values broadly resilient over 24 to 36 months. Everyone talks about how, COVID really could change some things and how people feel about sort of real estate in general and how we operate. What long-term effects of the corona outbreak do you see as most likely to impact capital markets and investment in real estate over the long term and permanently possibly stay in place?
Yeah, so long term, I see a continued decline in the cost of capital, i.e. the cost of debt as we move forward, and cap rates values will track the cost of capital over the long term. So 36 months from now, if prices are quite a bit higher and cap rates are lower, I wouldn't be surprised a bit, because, you know, real estate's an asset class that is going to be somewhat inflation resistant and is going to perform, I think, really, really well over the next decade. But we just need to get through the next 24 months.
And this question is going to dig a little deeper into that. Specifically, what changes in debt finance terms are you already seeing from lenders right now as compared to just 3 months ago when we started this? Are we seeing increased structuring, decreased loan to value, more upfront reserves? And how are lenders treating the different asset types with respect to the changes in terms at the moment?
Okay, great question. So the biggest changes have been obviously the increase in spreads or interest rates over the indexes. So that's because there's at the moment, there's more risk in the marketplace. Secondly, the loan to value leverage points have come down dramatically, anywhere from 5 to 10%. So if you could have gotten a life company loan at 60%, it's now 50. But the biggest impact on the debt market is there's just fewer lenders, right? So 60, 90 days ago, there weren't any CMBS lenders in the marketplace. Today, there's a few re-emerging. 60, 90 days ago, there weren't many life companies playing, but they were playing for just the select highest quality assets. Now there are. There weren't any debt funds. They've come back. So we have, the whole market has really been leveraging off of, first and foremost, what's the availability of the first part of the capital stack, which is the debt. And the good news is it's starting to come back slowly.
Great. Love to hear that. And this question's almost not fair, because I know we asked you to put your slides together a couple of weeks ago, and the world changes every 2 days or less. And you had talked in your slides about a swoosh recovery, given the reopen, reclose, spike issues that we're seeing throughout the country in the last, call it 8 days. Are you still projecting a swoosh shape recovery for the real estate markets? Or do you think there's some change in that?
So I did change my slides in the last 48 hours. They were even a little more optimistic 2 days ago than they are today. But we still are projecting a swoosh recovery. And it's certainly for, take a look at the industrial asset class and apartments. They're going to be really strong. Now, what's going to happen is retail, and Matt will probably talk to this, will suffer. And hotel is obviously going to suffer, and office. So it's very divergent by asset class.
And are the investors in commercial real estate pausing at the moment? I mean, you talked about sort of that first piece of stack and sort of that next one, or is there still, is that capital that's been sitting on that sideline? We know there's a lot out there because it had nowhere to go in this interim. Is it still looking at Denver, and nationally, is it ready to be put out there, that private capital?
So, Nicole, it's a great question. So the investors are pausing depending on the risk profile of the property. So if there are assets like a single tenant, long-term leased, high quality, newer vintage building, there is more aggressive capital pursuing that risk off property than there was 3 months ago. On the other end of the spectrum, if you have a bigger project that has a lot of vacancy, a lot of near-term rollover, there is very, very limited money available. That sector for the high-risk properties, could be almost any asset class, is virtually on hold. I call it stage fright. We just need to get some data points and transactions closed so that others can point to them and start a flow back in the market. But that's the tough part of what I do, is the value add deals are completely on hold at the moment, or to a large degree.
Great. Well, thank you so much, Tim. Right now, I don't see any questions from the audience, but we'll be bringing you back at the very end because I anticipate we have some. That was a great way to start this conversation with that overview. So I'm going to ask you to turn off your video. I'm going to add in Jim Bolt now. Jim has the great honor to talk about sort of the positive aspect right now, right? He deals with industrial, and as you saw from that last chart, that's definitely the component that's still faring very well. So Jim, I'm going to turn it over to you for your slides.
That is great. Thank you, everybody, and good morning. It definitely is a more positive topic than what we just heard. I'm going to cover three main areas very quickly here. I'm going to segue from Tim's conversation to capital markets in industrial. And I'm going to talk about Denver industrial fundamentals. And then lastly, sort of national fundamentals and what we may be seeing in the future in Denver. So first slide, please. Thank you. So as Tim mentioned, investment sales in the first quarter of Denver were robust, very, very strong. I think most asset classes were. However, with the shutdown, industrial also, that business shut down as well. Pencils were all down from all investors. However, we bounced back very quickly, and the business is open right now. Most investors are back in the market. We're even seeing some appetite for the stage fright investments that Tim was talking about, value add, which is interesting. On this slide, one thing to point out is that the price per square foot for industrial assets continues to move up. You can see though, if you annualize the 2020 performance because of COVID, we are going to fall short of the last 2 years' performance. Next page. So moving on to leasing trends in the local market, and you may have noticed in the last chart, I took it back to the last cycle where the financial meltdown happened. I did that here as well because I thought it was important to see where we were in the last down cycle. Obviously, vacancy rates have really plunged in these great years, this last 10 years of great performance. Big difference in the last down cycle between vacancy rates, and then you saw lease rates plunge. As vacancy rates increased, lease rates decreased. What's interesting so far is we're seeing vacancy rates drift up, but we're also seeing lease rates drift up. So that's an interesting phenomenon, partly because the vacancy rates are increasing because of new construction completions, and those are generally priced much higher than previous buildings, lease rates. Next page, please. So this also goes back to the last cycle. You can see the under construction amount and net absorption. And if you look at 2019, it was a record year for under construction properties in the Denver metro area. Likewise, we are there today in 2020. And the net absorption number for 2020 is a little misleading because that's not annualized. However, there is an imbalance. You want to see that light green bar higher than the dark green bar in a perfect world. We're going to fall short for the second year of, so there's a little bit of an imbalance of supply versus absorption. Next slide. So going more to the national area, you can see the bullets here. Nationally, the industrial market's performing extremely well. Low vacancies in really almost every market. As we mentioned in Denver, record high asking rents and positive net absorption. Predictably, what's happened in our business is there's been a huge push to e-commerce led by Amazon. We'll see a slide here in a second on Amazon. You can see the majority of industrial space is being absorbed as warehouse and distribution space. Nationally, the number is positive. It's a big number, 54.2 million square feet of positive absorption so far this year. Well, the next slide says 70 million square feet. Sorry, that was just warehouse space in the previous one, which is only 4% lower than last year. So we're right on where we were last year at higher lease rates. Next slide, please. So I thought this was very interesting. This sort of dissects the leasing that's being done nationally. And again, to the push of e-commerce, third-party logistics is really a form of e-commerce. So you want to loop those or group those two together. You can see between the two of them, it's about 54% of all transactions across the country. And then on the right, as I mentioned, Amazon Amazon thus far this year has leased 42 million square feet of space across the country. That's just staggering. We've never seen anything like that. It's phenomenal. It's helping push lease rates up because they're paying replacement cost rents. It's really, really phenomenal. I look for more of that in the next couple of years. Next slide. So in summary, in a long-term outlook for industrial space, interesting little bullets here. For e-commerce, $1 billion of e-commerce sales equals 1.25 million square feet of additional industrial demand. So the prediction is 2 billion square feet of additional industrial demand over the next 10 years. That's more than we've seen in the previous 50 years. Safety stock is also an interesting phenomenon. So this is as a result of the disruption of supply chain that we've seen over the COVID lockdown. Most big distribution companies are stocking more product, just simply in all of their warehouses. As you can see, just a 5% increase in this can total up to 400 to 500 million square feet of additional warehouse demand. And then supply chain diversification. This is onshoring of manufacturing. That's what we're going to see here. We're going to see this through 3PLs predominantly, but it's going to also have a big effect in the industrial space. Next slide. Thank you very much.
Great. Thank you so much, Jim. Very informative. And I'm going to start with a couple of questions that came from the audience. First, from attendee Tyler Brand. For industrial, what are the main risks for investors currently pursuing acquisition and development opportunities throughout the Denver market? What are the opportunities for each respectively, assuming a long-term 10-year plus time horizon?
Yeah, thank you for that question. A couple answers there. The first thing that pops into my mind is short-term, it's oversupply risk. As you saw on the under construction slide, we are at a slight imbalance for the next 12 months, let's say, of demand versus supply. So that's the first thing I would say. Other than that, it's really factors that no one can predict, second wave, et cetera. I do think Denver is lagging behind national performance, especially relating to e-commerce. So I see that we will actually get a boost in the next 12 months or so for activity.
And then another from the audience, from Clyde Wood, who's watching. Other than Amazon, who are the big distribution type users that will be active in Colorado in the near term?
Well, there are, unfortunately, there are a lot of transactions that are in the hopper right now in the queue that are closely held names. But I was adding up last night the e-commerce or 3PL related transactions that are in the market, and there's about 3 million square feet of deals that are pending out there. So there's some big deals, but can't really name them. There's some big deals under construction right now. A couple that pop into my mind are Shamrock Foods and Costco. There are others.
Great. And just talking about that under what's under construction, I mean, your chart definitely showed a significant amount of industrial space still under construction. Do you see that to be continuing trend in 21 and 22 in this market, or will we see a slowdown given what's come on in capacity?
Yeah, and I think we've already seen a little bit of what we're going to see, which is a pause. And the pause is really because most developers are looking at, they want to see the absorption of the current stock that's being completed, and they want to see that perform. But I look 12 months out, 18 months out, and I see that there's a big opportunity, because a number of the projects that are being built right now, there is not a significant second phase to them. So it's being built all at once. And land is hard to find. Development land in Denver is very hard to find. So I see a real opportunity 12 plus months out.
Great. Well, thank you so much, Jim. With that, I appreciate it on the industrial front. Very informative. We are going to ask you to stop your video now and switch to Shane Ozment from Newmark and Jordan Robbins from JLL. They are both going to cover multifamily segment. We'll let them both speak and then I'll ask questions at the end.
I think I'm going to get started here. Hi, I'm Shane Ozment. Thanks for having me today. Before I jump into really 20 minutes of material that I have about 5 minutes to present on, I'd like to thank NAIOP for hosting this event, everybody for joining, and I hope everybody and their families are doing well in these trying times. Can you guys hear me? I can't.
You're good.
Okay, good. Next slide, please. So where's the market today? When you look at Denver overall, rent growth has been pretty good, right? I mean, 2.5% year over year. That was really driven from May through September. Denver is very seasonal, and most of that rent growth took place in the into second quarter, third quarter of 2019. COVID has affected markets completely different, and obviously submarkets and asset class. When you look at the asset classes, it's apparent Class A is performing much better than Class B. Class B is performing much better than Class C. That's really driven by employment and demographics and the ability to have a job and pay your rent. Also, certain pockets of the submarket have been affected differently. East side of Denver, where it's predominantly 70s and 80s product, it has been a little bit challenging. When you get into central Denver and to the west, those markets have performed better. Downtown has really kind of suffered a little bit, and that's just a supply issue. I mean, if you look at Denver downtown, I mean, we have 6,000 units under construction. We delivered 4,500 units in the last 18 months. So really just supply and demand. And when you look at the rents here, you can see that you're seeing a rent reduction in downtown of $50 to $250. That's on new leases and renewals. You're seeing concessions of 1 to 2 months and all kinds of other giveaways, right? Parking, admin fees, and so forth. As you move outside the rings of downtown and you get to DTC, urban product, you're seeing really no rent reduction or very minimal, slight concessions 4 to 6 weeks. And this is really kind of a product as you move down the spectrum of asset class. We're still not seeing a lot of rent reduction. You're just seeing maybe a little bit more concessions to try to get people in the door. And then you get to suburban markets and they're performing extremely well. No rent reductions, minimal concessions on stabilized product. Obviously, if you have a community in lease up, you're going to give away 1 month free until you get up to, call it 90% or so. When we talk about delinquencies, as I referred to before, it's really driven by asset class. The folks in B and C products, it's not that they don't want to pay their rent, they just don't have a job or they have limited hours to pay their rent. It's been very challenging for management companies to move these people out, right? You can't do evictions, which is understandable to a point, but what we have going on now is even if you can start to do an eviction, the courts are so backed up, those evictions will take until the end of the year. So delinquency numbers will continue to climb, and it's typically 5, 7, 8% of your residents that just aren't paying rent. And if you don't pay rent for 4 or 5 months, you can see the delinquencies will continue to build. If we can move to the next slide. So I think Jordan's going to touch on this briefly, or Jordan's going to touch on it, so I'll speak to it briefly. I mean, the main point here is if you go back to first and second quarter of 2019, we saw 22 transactions. If you look at first and second quarter of 2020, we saw 20 transactions. Obviously, 75% of those transactions were done in the first quarter. We only had 5 transactions in the second quarter. You look at 2019 last year, third and fourth quarter are the largest quarters for transactions. We had 38. What I think we're going to see is probably at least a 50% reduction in transaction volume this year. Third quarter will probably look very similar to second quarter. And then I think we'll have double the transactions that we'll hit in the fourth quarter because we're starting to get listings. We're starting to see volume pick up. I mean, money has to be placed. There's so much money on the sidelines, and buyers need to place money that they have sitting in their account that they're paying a yield on and not able to place that money. So when you look at volume, I think once we get, Jim, talked about it before, and so did Tim, I think when we get to 2021, this time next year, we'll have substantial increase in volume. If we can go to the next slide. So I'll touch on debt briefly. It is very boring, but it's interesting with the delinquencies we have in some of the markets nationally. I mean, you can imagine that markets like Vegas and Orlando, some of these other markets, Midwest, are not performing very well. Denver is a bright spot for multifamily nationally. Loans in forbearance, very minimal for Fannie. It's a little bit higher for Freddie. Obviously, senior and student housing have quite a bit, kind of have the lion's share of those loans in forbearance. And then on the Freddie side, Freddie is a much more generous lender as far as requirements for small balance loans. So what we see is, those are loans $7.5 million or less, typically older product, mom and pop, smaller community operators, and they tend to cater towards more blue and gray collar jobs, and that's where you're seeing some weakness there. Some of the larger states, obviously, are leading the nation in forbearance, and Colorado is extremely low. We're doing it very, very well on this front. Next slide, please. So where's debt today? I can tell you debt is extremely, extremely cheap, as low as we've seen it in a long time. Keep in mind on the Freddie and Fannie loans that I have up here, 2 3/4 up to low 3s, that's for a full leverage 65% plus LTV with 5 years of interest only. If you go down sub 55% or even sub 65% or sub 55%, those loans get into the mid 5s. You really do only have two or one lender in the market right now, and that's the agency. So Freddie and Fannie are really the only go-to. Lifeco is lending, but they're extremely conservative. We did have some changes in lending with COVID. We had the lenders go and start adding, making borrowers escrow or reserve for principal and interest. And then they really jacked up the cost for tax insurance and replacement reserves. Those have come down to pre-COVID levels, but they're still reserving for P&I. You do get that money back in anywhere up to 18 to 24 months, but it still does increase the cost of doing a loan. Next slide, please. So building permits. This is really my favorite slide here. It's very telling. This slide is the crystal ball for what's going to happen in Metro Denver going forward. If you look at 2017, 18, 19, and the first 2 quarters of 2020, you can see a trend starting in first quarter of 2018. The blue bars are multifamily single permits that are multifamily. The green is single family. Single family has been very steady, but it is starting to decline. Keep in mind, we only build about 13,000 homes a year for single family in all of the metro in a city that is, breaching 3 million people. On single family, if you go from 2018 to 2017, or multifamily, we saw about a 5% reduction. When you move from 2019 to 2018, we saw a 24% reduction from 2018 and a 27% from 2017. When you look at building permits that have been pulled for multifamily in the first half of 2020, we pulled 2,518 building permits. That's a 40% reduction from 2019, 60% reduction from 2018. And, what is the reason for this, right? So these deals that have already closed and the permits that have been pulled, those were already in the pipeline. As we move through the rest of the year, most developers, and Denver, keep in mind, is a merchant-built city. Most of these developers need equity. That equity are big Wall Street companies and life insurance companies, and they have plenty of other avenues to invest their money and kind of wait and see what's going to happen with COVID. So what this is going to do is it's going to create a slack of anywhere from 12 to 24 months of reduced permits. And that slack will create less and less product going forward. If you go to the next slide, please. This is what's going to happen. As you can see, the blue is deliveries. We're going to continue to see deliveries drop every year. And keep in mind, the one thing I didn't mention on single family is we only pulled 3,500 single family permits in the first half. So we could conceivably only see about 7,000, 8,000 homes built next year. So as you drop down in deliveries, that's going to put pressure on rents to increase because vacancy is going to decline. And I think when you go forward and look at 2023 through 2025, we're going to have a housing shortage in Metro Denver. We had one running in with all those deliveries that we had housing shortages running into 2020. We are absorbing more units than we are delivering. What will happen going forward is with the lack of units, and if we get back to pre-COVID Denver economy, which we all know we will, and it will probably be stronger than it was before, is people have exodus out of these larger cities, continue to move to Denver for jobs, quality of life, and so forth. We will see rampant rent growth of, I believe, 6+% for 3 years or so until that rent growth or construction starts to pick up. That's it. Thank you.
Great. Thank you, Shane. And now Jordan.
Can you guys hear me okay? I've been having some technical difficulties here. Hopefully you can hear me fine.
We can hear you just fine, Jordan. Thank you.
Okay, great. If I drop off, I'll dial back in 30 seconds. So quickly, just to add on to what Shane said, if you go to the next slide here, just a quick overview of what we're seeing in the overall market. The two biggest things to point at here are average rent, still just north of $1,500 a month, occupancy levels, 94%. So Denver, just relatively compared to our West Coast markets, is very affordable from an apartment perspective, and that's why you've seen a ton of growth here. If you go to the next slide, like Shane had mentioned, you look at the single family building is still happening, but the product that's getting delivered is very expensive. $465,000 average or median home price. So that's really driven a lot of the fuel behind the growth in these past years. Is it's still very expensive to buy a home in Denver, and so you're seeing when folks move here, to rent, is oftentimes 50% of what it would be to buy a home, and where people are looking to live downtown, it's even a wider gap than that. So you're seeing that fuel a lot of the growth in rents, and you're seeing investors really focus on this when they're looking at why to invest in Denver, where we're looking at future growth. And you look at the red line there, the home ownership rate in Denver has gone down. It did increase, but it is flattening, a lot of it due to the cost. If you go to the next slide here, what we're seeing from an investment perspective, just generally, is an unprecedented amount of capital out there. You look in 2019 was the biggest year since really we've been tracking this data from a capital raise perspective. So over $100 billion raised last year. You look at the amount of dry powder that's left is still staggering. So you're close to $200 billion in just dry powder, which is why you've seen, at least on apartments and industrial, are kind of the darlings of the investment perspective. But there you've seen cap rates stay flat even during coronavirus. And a lot of it is just because of the availability of capital and number of funds. You look at almost a 20% increase of capital raised in the last year, but most of that's getting fueled by the largest capital providers, Blackstone, the CBRE Globals of the world. And so it's an interesting concept because you're just seeing as much capital as there's ever been, but a real lack of deals to get done, which is why returns have stayed so low, especially for apartments and industrial. Go to the next. And these groups are just having a tough time getting this money out. And so targeted allocations, just generally for real estate, was 10.5% in 2019. They were underinvested by, almost 110 basis points. And so they're, again, funding more money to apartments, funding more money to industrial, less deals out there. And so we just see a continued appetite for at least apartments moving forward. And then you look at, if you go to the next slide, Denver specifically, why people like it, it's falling population growth, it's falling employment growth. So you look at the size of these circles here are where the most growth is happening. So Denver is very in vogue from that perspective. You look at some of the other markets that we're competing against, Austin, Dallas are still very attractive, but Orlando and Houston, where a year ago, those would have been really attractive markets, given, the Orlando reliance on travel and leisure. Houston, oil and gas issue. We just see more money coming to Denver. Go to the next slide here. But it's, a very liquid market, and it continues to be a liquid market even through everything that's going on the apartment side. So we've got a number of deals in the market. We're not seeing any lack of interest in any of our deals, equal to what we would have seen 4 months ago, and pricing a few deals right now where pricing has not changed from what it was, 3 or 4 months ago. And then you go into I think this is the last slide here that I've got. Like what Shane had said, multifamily sales nationally on the left there are down substantially over where they were first quarter of 2020. Same trend here in Denver. We're obviously down a lot compared to where we were this time last year. And just given all the money that's on the sidelines and some of the things we touched on from a, income or rent to own perspective, employment and population growth, we think Denver is really positioned well to be an attractive market going forward. That's it.
Great. Thanks so much, Jordan. I just have, you guys covered it so thoroughly. I only have one question for each of you. So Jordan, I'll just start with you. You talked about all the dry powder out there. We certainly, and how the sales have dropped off in the second quarter. I would anticipate that a lot of that sales drop was in part because of everybody waiting to see delinquency rates. And since delinquencies in the Denver metro area, and I think even across a lot of the country, have not been as high as have anticipated, do you think we'll see a quicker uptick in sales since they haven't seen the delinquencies? Or are people still waiting to see if those delinquencies increase as PPP and other Fed funds run out?
Yeah, I think here, just what we're hearing on a national basis, there's more deals in the market in Denver than in other markets. I think because of how resilient we've been the last few months, also debt is just super attractive right now. And so I think people want to get out while investors can consume the attractive debt terms. And so with Denver performing well, April and May it was pretty much down for everybody from a collection perspective, but June bounced back. And so you're underwriting on a really strong, call it T3, maybe not as strong as it would have been in March, but you're underwriting on a strong trailing 3 basis, and collections are good. So debt terms are really strong, which is why you've seen values hold up. So I think you'll see here in Denver more deals that'll come to market and are already in the market than in other markets that have been hit harder, like a Houston or Vegas or, Orlando. And we're also from a political landscape too. When you look at California, Chicago, New York, there's a lot of crazy people out there doing crazy things that are just, it can crush investing, which has unintended consequences that no one thinks about. Hopefully our politicians in Denver understand that better than others.
Yeah, we can have
Hopefully there's no politicians on this call.
We can have a different discussion about that some other day. But yeah. we still not as crazy as some crazies. So great, thanks, Jordan. And then Shane, question for you is, we certainly are seeing some movement to Denver, as you said, from those really, really condensed urban areas. But one of the things that's been talked about as this sort of pandemic has hit is this real rush and movement out of urban core. And even though we may not think of it, other people think of, downtown Denver and urban core is still pretty condensed. So are investors who are considering Denver, are we seeing more movement outside of that urban core as that sort of flight to the suburbs is happening from the pandemic, or are we not quite seeing that here yet, and that we're all consider the Metro Denver as outside urban core?
Well, that's a great question, and it's a little complex because typically multifamily investors, you have some investors who want core, and you want some investors who want suburban products. So they have two different buckets of money. So they tend to not play in the same backyard. Some do and some don't. So the Avalon Bays of the world, they're suburban buyers. They're actually starting to build in downtown Denver. But yes, I think, Denver has been a millennial boom city. It will continue to have millennials and Gen Z migrate to Denver. They tend to spend the first year or two downtown and then migrate to the suburbs. I think suburban product, obviously due to lack of construction, municipality laws, you take Lakewood, for instance, anti-growth. I live in Golden, anti-growth. Boulder has anti-growth. Very challenging to build in Arvada. Littleton, you run up against the Front Range. So investors, if they can buy on the west side, they would love to buy on the west side and migrate to those markets just because of lack of product. But yeah, there's typically two different buckets, and there's plenty of money to go around. And the thing about downtown, and I'll mention this briefly, is there's always limited product that trades downtown. So when an asset hits the market downtown, there is typically just a ton of interest for that product. And hopefully we'll see that, not as much this year, but probably a lot more downtown product that hits the market next year.
Great. Well, thank you guys to both. I am now going to turn over to Eric Roth from CBRE, so Eric can talk about land.
Great. Good morning. So generally what we saw when COVID hit is certainly a paralysis for a period of about 6 weeks. But what we noticed is coming out of that 6 weeks is that the two sectors that performed the best pre-COVID came back very quickly in terms of development demand. Those would include multifamily developers and certainly industrial developers. So if we can go to the next slide, please, we can kind of break those two up, or at least start with the residential land component. So on the multifamily development side, development is absolutely intact. This is based on phone calls and offerings we've taken out to market. The offers that have come in have been pre-COVID in terms of the amount of offers coming in and the pricing. So we feel very confident that that's intact. People seem to feel like, by the time they get entitled and approved and get site work done and construction, leasing units, that's still 24 months out, best case scenario. So it feels like by then there should be, a cure of some sorts. So what we have seen though is, certainly the concern is construction debt. If you were having permits in hand today, you'd be pretty nervous in terms of if you have to get construction debt from the big money center banks. We are hearing people are getting construction debt through more of the regional banks. So that is starting to thaw out, which is a good sign. I'd say if I were to place the demand spectrum of where people are most interested, I would say it would be in the suburbs. Shane mentioned that the west side of town is certainly attractive. We had an offering in Arvada that was very well received. And it was two things. It was the west side of town, which is always tough to find a site, but also it's just a lower cost basis play versus a downtown product where, you got to go, very tall and construction costs get very high. So I think that also is playing into, why the suburban product is in high demand right now. And then the other trend that we've seen is a significant amount of inquiries of multifamily groups that have traditionally done 3, 4 and higher story products looking to do single family rentals in communities of anywhere between 150 to 250 units, which starts to play in the home builder sandbox. And when they start talking about, well, how do we build this, they're starting actually to talk to the public home builders in a GC format, because a lot of these groups know how to build multifamily very well, but they don't necessarily know all the ins and outs of building single family. But I've been very shocked on the amount of calls we're getting for people looking at, can you find me 100 lots, 200 lots in a suburban location? So, and I think that trend is going to stick for a while. Home builders, so absolutely, it was interesting when all this happened. We saw a lot of the home builders laying off staff. I think they were even shocked at how quickly home sales rebounded. And what we saw is a lot of those groups, some deals got dropped, but most every one of the home builders, and this is across all land sectors, just asked for more time. And, so we did see the home builders is definitely pulling back the risk, a little more conservative, and instead of wanting to maybe develop 300 lots, looking at maybe rephasing into 100 lots so that the capital outlay is not as much. Certainly saw the upper management of the home builders pull back the financial range of the acquisition guys, meaning they didn't want them to get into big, lengthy entitlement projects that cost a lot of money and a lot of money out the door. We think that shifts pretty quickly back to pre-COVID here in the next couple of months, just given the home buyer demand. Suburbs obviously in high demand right now, and that's where most of the home building takes place anyways. Attached product had been coming back pre-COVID and remains strong, mainly because land pricing is high, and if you can get more density and you can get more kind of more economies of scale, it makes a lot of sense. Next slide, please. Jim mentioned industrial demand is certainly has not acquiesced at all. So developers are still out there looking for projects. Distribution warehouse very active. Jim said it best. Development opportunities in land are very scarce. What we find with these bigger industrial projects, they have a huge footprint. They take up a really large site that needs to be close to major arterials. And most importantly, it has to have the zoning. And historically, cities just have kind of frowned at industrial zoning. We think that starts to change at some level, but very hard to find those sites. Office development, very tepid, not seeing really any new pursuits unless it's some type of build to suit. A lot of the projects that were permit ready have been shelved. A lot of the developers we talk to, the hope is that they see demand come back and they reprice the project. And if they can get 10 to 15% less in construction pricing, they'll consider that a win. But most people are being pretty patient, absent some type of anchor tenant. Next slide, please. Hospitality land, again, one of those sectors that it's going to be in pain for a while. We see that, not really many people are looking to start new projects. And if there's equity out there in that space, they're more likely just to sit tight, let some, foreclosure activity happen and put that equity into some type of distressed opportunity versus going to go build new today would make a whole lot of sense. Retail land certainly, was never on fire before COVID, and certainly is not now. We're seeing some limited activity in pad users out there. Anchor activity is pretty much non-existent. What we're also seeing, which we saw last year and the year before, is that most owners of very large format properties are starting to relook at their site plan, saying, what parts of the property can we demolish and put in new sources of activity. In most cases, that would be multifamily. So the redevelopment play is certainly what we see the trend being for the next number of years in bigger format properties. The big question, which it always is, what are the cities going to allow? I think they've always, cherished those tax dollars, but at some point, I think that, hopefully reality sets in that some redevelopment of some of these brings some more bodies to the project, and you got to keep the retail that you have that's existing, you got to keep that healthy. And the way you do that is you bring more people in. Next slide, please. So the biggest concerns we have for the land market is entitlements and approvals. Still a challenge. We're hearing a little, some of the cities are easing up a little bit, but not in a major way. Residential is typically going to be the best anchor for these big, large tracts, but it always seems to be the toughest component to get approved. We don't necessarily see that changing. And then, of course, attack on metro districts. What we've noticed over the years is that really the only way to get a lot of these projects up and going and financially feasible is you need a metro district to make them work. When you start layering in all of the horizontal cost, which for residential is about $1,000 a linear foot, add on all the impact fees, a lot of these big projects just don't make money unless they have a district. And so that's certainly something on the radar. And that's all I have on the slides.
Great. Thank you so much, Eric. Certainly resonates with me as somebody who does land development entitlement deals. It's been an interesting few months and continues to be interesting as we try to work through entitlements and just the development process. But certainly development seems to be keeping us as busy as those deals keep going forward. Just one question for you where I think your expertise could really come in is sort of what is the percentage of existing deals that you've had to renegotiate as a result of the pandemic as it's slowed everything down? And are there a significant number of land deals that buyers chose to walk from as a result of COVID? And sort of what you're seeing is the biggest change in negotiating land deals given the current pandemic situation? Sorry, I just loaded a lot in there in one time.
Yeah, no, great question. So, what we saw is that in terms of renegotiation, most of the points that were renegotiated were, hey, we need more time. I didn't see a whole lot of price negotiation, which was very surprising to me, quite frankly. But people essentially, if they were free non-refundable earnest money, they certainly asked for more time before they would go non-refundable. And if they're already post-DD and they had non-refundable up, they would ask the seller, hey, we just need more back in time. And a lot of that was just because they couldn't get responses from the city. The cities weren't really processing anything. It was just kind of this period of nobody knew how quickly you could get anything processed. City councils really weren't meeting. So that was the number one request that we saw. And I would tell you most sellers went along with that. We saw very few sellers be difficult with the thought process of, this is out of their control. And, it's unlikely a new buyer is going to step in and be able to perform quicker at a higher price anyways. So why would you depart from your current buyer? So I'd say that's the biggest thing we saw in terms of renegotiations. Now going forward, it seems like deal terms are kind of back pre-COVID. The concern is timing mostly, and if there is another wave, are the planning departments going to be able to make the turnaround times on submittals that we all expect? And I don't think anybody knows. So we are kind of seeing some more back-end extensions being built into land development contracts, and where people just put up some more money to get more time.
Certainly what I'm seeing. So great. Thanks so much, Eric. And with that, we're going to move on. We have so much information. We have 2 more segments we want to talk about. We know we might go a couple minutes over, so we ask everybody who's listening to continue and stick with us, because certainly you'll want to hear these last 2 pieces, first being retail and then after that being office. So, and I apologize, when I was doing introductions, I was grouping wrong, and Matt DeBartolomeis is not speaking about office. He's actually our retail broker expert today. And so Matt, I will turn it to you to talk about retail.
Well, terrific. Thanks a lot for having me today. I feel like retail here is a little bit of the stepchild. It seems like it comes up in a lot of other cases where it's a lot of change going on. So if we go to the first slide, this is just a snapshot of the Denver market in Q2. And what I think really stands out here is that, there is negative absorption of 278,000 square feet, which quite frankly is incredible. But also thinking about how much we did have absorption, there was actually 750,000 square feet put back on the market during this quarter. So as we came out of COVID, a lot of these retailers didn't open. The biggest contributor there was probably 24-hour fitness, with 9 locations that they did not reopen. And so that was a big number there. So we will see similar, but not this magnitude of numbers as we get into the third quarter, because there's a lot of the retailers that have filed for bankruptcy that are doing their closed in store sales that haven't really hit the market as a negative absorption yet. And that would be, people like, GNC, and you see all the closed in store sales with Pier 1. So we'll see this number continue to grow. But what I wanted to focus on today was more about national trends as they relate. Retail really is a national perspective, not just individually in each market. So if we go to the next slide, we'll see some things here. Everybody's talked about it. Retail's been hit hard. It's been a tough road for a lot of these retailers. So between hotel and restaurants and retail, we've lost 10 million jobs. And that is an incredible number. And if you think about those 10 million jobs and how they were and how they affect the business and people's buying powers, it really it's been amazing. So let's look at, we hope that as we get through the next month and the next quarter, a lot of these jobs will be absorbed. But the fact is that a lot of these people that are unemployed right now and collecting an extra $600 a month are sometimes in this category of the income levels of these areas. They're making more money or the same amount of money by not working. So that will expire at the end of July. So we hope that a lot of these jobs will be coming back as we get into August, and we see that go from there. So we're really thinking that would be a big deal for us. And I think a lot of these retailers are hurting right now. And I think the real key is that we have some new legislation that is in Congress right now that is called the Small Business Comeback Act. And what that will do is that certain businesses that can prove that they had some serious hardship during COVID and the pandemic, they can apply for a grant of money coming back. This will be quite different than the PPP dollars that were really focused on payroll. So look for that to come through Congress, which will help a lot of these small and medium-sized retailers to get back into business and to be able to fund their losses and where they are. If we go to the next slide, there is some good news. Retail sales are up. We have a 7.5% increase in retail sales in the month of June. That is compared to June in 2019. So really some great news there. So there's definitely some pent-up demand that we saw sales in specific categories such as automobiles, furniture, and even clothing and electronics. But so we do see some pent-up demand. We hope that will continue, but with certain spikes in certain cities where there are some concerns. I mean, look at California right now that is closed, I think 30 some malls. And so there's no retail being done there. And then you look at some other cities that there's now stay-at-home orders. So hopefully that will pass through, and then we start looking forward to back-to-school sales, because back-to-school sales for most retailers is the second peak compared to Christmas and holiday season. So a lot of people look to back-to-school sales right now and seeing where people are starting to spend their money. So the question is, are they going to be spending their money on jeans and hoodies, or they're spending money on laptops and tablets? So going to the next slide here is, it's kind of an interesting slide, and it really talks about the pain and the change that we've seen in retail. And so within retail, we're sitting here with a bunch of different categories. But what's really cool is if you look at the green bar, that's like the 5-year historical growth within each category. And then what we saw in first quarter. And a lot of them were similar. So what we saw were some categories that have benefited, and then COVID has really benefited them in their growth, such as the non-store retailers, such as internet sales, Amazon, and so forth. Groceries done really well there. But then there were some other categories that, building equipment such as Home Depot and Lowe's has really benefited from this. But there's a lot of categories that have been downtrending and for this growth, and that has been like department stores. And we look at department stores such as Macy's, Neiman's, JCPenney, and even Nordstrom's closing in our own market. They have been downtrending, and this COVID event has really accelerated that. And then we'll look at maybe clothing and fashion in general, such as the Gap and a Children's Place, and Victoria's Secrets are all closing a lot of stores at that point there. So we go to the next slide, kind of where we are here now, and what's going to happen in the near future here. And that is that, the fact is we are on track right now to probably close 25,000 retail stores across the country this year. In contrast, 2019, it was like 9,800 stores. So we'll need a lot of these stores to close, kind of settle into the vacancy. We're certainly going to see increased vacancy. And then a lot of these retailers that are in bankruptcy are going to get rid of their non-performing stores, and then they'll shed some of those stores, and then things will settle out in 2021 for us to really understand what the market looks like, where the pricing is going to be, but certainly greater vacancy, a decrease in asking rents, and that it's going to be a slow growth. As some of the presenters presented earlier, retail is probably going to take 36 months to really get back to where it was. And I do believe it's certainly 24 for us to get back to those numbers. Those are my slides. Do you have any questions?
That was so uplifting, Matt. We know you've got one of the hardest ones to talk about. Not a lot to add or question there, because I think the numbers speak for themselves. I think the one question I have, because again we're seeing it and dealing with it as attorneys, is what do you think the biggest long-term impact, sort of this pandemic, this thing that none of us really used to think about, but now it's out there, it's happened once. What do you think that will have as far as the future of retail lease negotiations?
Well, the number one ask everybody is like, hey, I want to strengthen my force majeure language. I really wanted to include, government shutdowns. I wanted to include pandemics, but more importantly, using that force majeure language to not pay rent, because it doesn't always align to not paying rent. It's usually of a pushback. So I think that's the number one ask. And we haven't seen any landlords really agree to that at this point. There's been some consideration, but I think if they're not going to get that, then I see shorter terms. So where someone was always a 10-year person that said they had to amortize their costs, they had to kind of put their capital in order. It was a 10-year deal. Now they're looking maybe a 5-year deal. Or possibly maybe they're looking for an out. But most of them that were 10-year deals are looking at shorter terms so they can protect their downside.
Great. Well, thank you so much, Matt. Very, very informative, and hang in there in this market. So.
Exactly. Thank you.
Great. And now for our last two, we have, again, apologies for misintroducing where our grouping was before, but we have Lee Diamond with CBRE and Dan McGowan with JLL, and they're going to talk to us about office. I think this is the segment that most everybody looks at and says, we really don't know. It's got some definitely interesting questions, as all of us are on Zoom and tend to be working from home and not in an office right now. But where do we go? So Lee is going to start. So Lee, I'll turn it over to you.
Thank you, guys. It's very nice to be here. Really appreciate it. I am talking on behalf of our team, which is me, Lee Diamond, Doug, Ty, Todd, Melanie. Let's go to the next slide. I'm really going to talk about three themes. Number one is differences between Q1 and Q2 in the overall Metro Denver landscape. Number two would be some COVID impacts. And then last but not least, some predictions, not CBRE necessarily, but Lee Diamond predictions for our three largest submarkets. So with that, I'm going to start with Q1. Basically, rents have been flat for the most part. That said, though, there's really three themes to take from this slide. Number one, we saw negative absorption to the tune of minus 84,000 feet for the very first time in 13 quarters. That was significant. That is something that we feel is the start of a trend, unfortunately. In addition to that, we saw, as expected, sublease space overall increase by 33%. We now have 3.4 million feet on the market for sublease. That's obviously increasing the overall availability rate, which we'll talk about. But that number was at 2.5 million feet at the end of Q1, so pretty staggering. In addition to that, the other thing I want to point you guys to is the under construction numbers. We're at 3.7 million feet. That's up 50% year over year. From that perspective, as you can see below, we're mostly in downtown and southeast with the new construction. That consists of really 5 to 6 projects for the most part. We're at 1.47 downtown, 1.15 southeast. Let's look at the next slide. Obviously, what happened since March, we had a big impact. The biggest being familiarity with new technologies. Zoom comes to mind. Here we are. Zoom happens to be a client of ours. They're doing great. We're really proud of them, and we've benefited from being able to help them as well over the last few years. But that said, what's going on with tenant mentality? Well, a lot of short-term renewals, a lot of kick the can approach. We're doing a ton of 6 and 12-month renewals. Nobody really knows what the long-term effect is going to be because of this, but they are planning, most companies, on having a rethink on their productivity. They're realizing they can work at home a little bit better than they thought pre-COVID. There's a rethink on capital plans versus continuing to work at home. And what I mean by that is, right now you're seeing a little bit tighter checkbook and tighter approval process relative to spending capital. especially given the mentality of a lot of CFOs that, if they go spend capital to change their workplace into something today, and then 2 to 3 years down the road have to spend money again to change workplace back to the Google-esque model, for example, then they're not going to get the ROI out of that workplace. They'd much rather stay at home longer and be more flexible with their employees versus spend capital. What we're starting to see now, and a lot of you in the audience are experiencing this, is a reemergence into the workplace. What we're seeing a lot of is rotational schedules being affected. And what that means is, 20, 30, up to 50% of people in the office at any given time. However, from that perspective, still leaving the door open for a lot of employees to continue to work at home for safety concerns. My forecast, again, this is Lee, not CBRE, is that overall demand for office space, unfortunately, in the near term, so call it in the next 24 months, will actually decrease by about 10%. And when I say that because of a shrink of footprint mentality, meaning a lot of tenants and clients that we work with and talk to are planning for really a 10 to 25% reduction in overall space need. And that is because of hoteling concept, call it a longer term 10 to 25% of people not being in the office due to work at home. We will continue to see a flight to quality over time, which means Class A space will continue to be desirable in our minds. There's going to be a big rethink on size on the long term due to financial savings. And a lot of CFOs right now, we feel are really in two categories. One is, they want to create a workplace and brand and culture, and they're using, COVID as a excuse to do it, based on the work at home, meaning giving employees the flexibility, which they like, it seems like they like, although they still want to have an office to go to. And then in addition to that, you have the second mentality, which is using the COVID atmosphere, we believe, as a driver for cost savings. So to put cost savings initiatives into place and to actually use this environment to drive long-term savings and run rate reductions. Let's look at the next slide. My forecast for markets, downtown, unfortunately, we could see what I see is a 20% direct vacancy rate. Right now we're sub 15 and a 30% availability rate. We're at 20 right now. Roughly, if these three things happen, 40% of oil and gas space becomes available. We're well on our way. Unfortunately, 30% of flex space or agile space coming available. We are also on our way there. And then technology companies, very interesting topic. If 20% of technology companies give their space up or put it on the market, at the end of the day, we think if those three things in aggregate happen, we will be at 20 and 30. I do see about a 10% decrease in rates overall downtown in the short to midterm. As you guys can imagine, there's already been an increase in concessions, tenant improvement allowances going up, and also free rent going up. In those estimates, I've got 1 million feet of pending vacancy within 12 months due to new construction. That also does assume a 25% pre-lease on these buildings downtown. I don't know if we'll be at 25%. We're at about 7 right now. So still some work to do, there, although 20 and 30 might be attainable. And unfortunately, that's not very good news for downtown. Northwest and Southeast, they really kind of function together. What I see is a flat market overall in Northwest and Southeast. There could continue to be a Boulder domino effect, meaning Boulder softens, Boulder companies will expand in Boulder, not go down the corridor. Or what they might do is what we've seen in the last 3 years or so is companies from Boulder coming into downtown for the first time, bypassing Northwest. Overall demand, per my prediction earlier, at 10%, slowing. Will have a minor effect on Northwest. It'll also have a minor effect on Southeast. I see those markets as being fairly flat, although from a concession standpoint, I do see concessions continuing to go up. But long-term, those are in pretty good shape. Obviously, biggest concern is downtown short and midterm in my mind. From that perspective, it's been great. I appreciate you guys having me, and we're going to move on. Dan McGowan's going to talk to you further.
Great. Thanks, Lee. Dan?
Thanks, Nicole. Thanks, Lee. I'd really like to think that we saved the best for last, but given about what I'm about to say, I think there was another reason why we went last. This pandemic has brought the office market to a halt since mid-March. Unless driven by lease expirations or critical business functions, most companies are on hold as they're focusing on their business operations, health and safety of their employees, and they're watching how the market turns out. We're encouraging our clients to do that, but to also, in addition, is to evaluate what their needs will be long-term, reentry approaches, and strategic planning, so that they're prepared when they're ready to enter back into the market. Denver's also experienced a double whammy due to the energy industry and severe drop. We do expect those conditions to unfortunately worsen over the next 3 to 6 months, and then hopefully stabilize by the end of the year. Pricing equals stabilization and recovery, which is all driven by demand. So until we see that long pent out demand come back to the market, the energy industry is going to be impacted severely. And that's not just for the CBD market. That's going to bleed into Southeast and Northwest as well. Leasing activity since April 1st is down 70% from a year ago, and we expect to see that trend continue for the third quarter. Lee mentioned sublease rates being sublease square footage being about 3.5 million square feet. The all-time high in Denver is 3.9 million feet, and we expect to hit that and exceed that over the next 90 to 120 days. The most active industries in the market today are defense companies, life and biosciences, and some subsets of tech, healthcare, and finance. Next slide, please. So really what companies right now are looking at, they're really looking at 3 different buckets. They're looking at survivability, which, yeah, we've seen a record number of bankruptcies. We expect to see more, especially in the energy industry. Lots of mergers and acquisitions. There's one in the newspaper yesterday that was pretty substantial. And then a continued of the PE mashups, where you're basically taking 2 or 3 or 4 companies with the same PE backers, and you're combining office space, assets, and executive teams that really have a dramatic impact on real estate needs. Assuming that they have companies have that under control, they're looking at what the work from home impact will be. Lee mentioned that everybody's become a Zoom expert, and they have, but long term, what that technology impact will be to companies as they look at productivity levels, communication with their teams, and how do you actually advance the ball forward. Productivity right now is as much as we've seen it stabilize or people provide positive results, the long-term metrics of it and the long-term impact of productivity won't be known until at least the end of the year, if not a year from now. A lot of people and thoughts as they evaluate is how do I go from defense to offense? And it's very hard to do when you're in a work from home environment. And then the third bucket is really the future of office space. And companies are looking at in 2 different buckets. One is short term. So immediately through the next 3 years, how do they operate effectively? How can they operate effectively? Applying more of a work from home impact. What the other positives and negatives of work from home. Obviously, if you're working from home, you might not need as much real estate moving forward, but there are significant negative impacts to the culture of firms, to firms that are used to doing team events. And you know, I can speak just personally is it is so hard and challenging to schedule meetings with folks when you could have easily walked down the hall and have had the discussion and move forward. So companies are evaluating that moving forward. And then ultimately, what do they do with the current space? Lee mentioned there's a lot of kick the cans. There's 6-month extensions, 1-year extensions. People are really just trying to buy time to figure out what their ultimate needs are. And we're seeing a lot of success and a lot of loyalty that'll be driven when both sides are working well together in order to accommodate that. And then long term, over the next 2 to 3 years, is how does their business model change because of and what that results to real estate because of work from home and because of this massive experiment that we've all accelerated. Work from home is not a new concept, but the acceleration and the forced experiment for essentially every company, office user out there has really challenged the model, the previous traditional models. So understanding how you can be more productive, how you can reduce costs, how you can make smart investments on technology that might offset office rents, and then implementing different strategies like hub and spoke. Does hub and spoke apply to just regionally or nationally, or is that something that you could apply locally where you have a central location in CBD and something up northwest and something down southeast? Is there a trend of suburbanization where what used to be looked at as a recruiting tool of having mass transit and lots of building amenities, do those positives almost turn into a liability now? And how do companies evaluate that? And are they better off moving to the suburbs where they can provide parking for their employees, control who enters and exits, control HVAC, just creating that health and safety and wellness for the employees? And then de-densification. So as much as work from home will certainly reduce the overall footprint of the square footage need, there will be a focus of rather having a 7 or 8 or 9 per thousand ratio that we've seen, especially downtown, to where it's a more of a, you pull it back to a 3 or 4 or 5 per thousand ratio, and that offsets some of the square footage savings with the work from home. The other big question out there for all of this is what happens when there's a vaccine or reliable therapeutic? Next slide, please. So really kind of the big considerations as we go through this, and there's no right or wrong answer. There's no clear solution. Everybody is, and that's why we're really on this holding pattern, is until there's a vaccine or therapeutic, disruption will be significant and it'll be ongoing. The energies in continued space give back, along with other industries, will have a significant impact on the CBD and other markets. Work from home will, while it's not a new experiment, what companies will truly implement it long-term and for what type of business functions, that's a massive consideration. The concern over density and safety of their employees will impact real estate decisions moving forward. Will companies stay at 15% of work from home and create those satellite offices? We just don't know. And then will our industry diversity help or hurt this recovery? The 3 largest industries in Denver are energy, tech, and finance, and the 3 largest subleasers of space right now are energy, tech, and finance. So we need to be mindful of that as we watch what happens. And then the final point is oil prices in 2008 were $126 a barrel. In 2001, they were $40 a barrel. The recovery in 2008 was half the amount of time in 2001. So looking at, as much as we are a more diverse economy, the energy impact is extremely important to Denver's recovery and must be paid attention to. Thank you.
Great. Thanks so much, Dan. So you covered some of the questions I actually had for you. So now I'm gonna narrow here, and I have just one question for each of you. Let's see. You pick who answers this one, because then you get the other one. Where do you sit on this debate as to if the pandemic has made us realize that there's no need to go into the office anymore, or that there will be a strong return to the office because we all feel like we actually need the office and need people? So raise your hand quick who wants that one.
Lee, up to you. If you want to answer it, I'll take it.
All right, I'll take it. So great question. I think inherently people do want to be in the office setting. I think they miss the social aspect. I feel like it's hard for some people to work at home. I feel like childcare is an issue, potentially, inhibiting people from going back to the office. From that perspective, though, I think people need to have that social interaction. I think teams work together in person much better than over the Zoom. I also believe that there will be that footprint shrinkage like I talked about, and there will be more flexible model for employees to come in, basically on their own terms. And from that perspective, that will build culture and brand. But in order to have truly an effective culture and brand, you got to have an office.
Yeah. Agreed. I'm so ready to be back in the office with my team. So thank you for that, Lee. All right. And then Dan, this one for you. It's sort of a similar question I asked to Matt. What do you think the biggest long-term impact of COVID will be on the future of office lease negotiations?
So a few. One, I think there's going to be at least a half a dozen new lease clauses that go into every document, and especially in RFPs and LOIs. There's always been a challenge on the shutdowns and the rent recoveries and everything else. So I think you'll see a focused effort on trying to define and prepare for any future pandemic-like events that we would have. I think the ultimate goal, at least over the next 3 to 5 years, especially as we continue to work from home, evaluation is lease flexibility. And what you'll see with that is companies want to be nimble. They want to have future abilities to either grow the work from home concept or maybe expand back if they figure out that our productivity levels aren't just working there, or our culture has been severely impacted. So lease flexibility will be huge, but that's going to be offset by construction costs and how that approach. The capital spend. Lee touched on it. I talked a little bit about it. The capital spend is pretty dramatic, and we had seen a massive increase over the last few years on construction pricing. So that's going to be all counterbalanced and evaluated as you look at space options.
Great. Thank you guys so much. That was very interesting on office, and I could go on with a lot more questions because your segment's fascinating right now, but we have gone over our time, but I'm going to ask all my panelists to jump back on. And for those who are listening, we appreciate you sticking with us as we go through this. I had a number of questions. Had we run short, I should know we wouldn't, because there's so much great knowledge here to share. Okay, so I have one last question for the group. And I think for those who've stuck with us, it'll be interesting for you to hear the answer. The group's only allowed to answer yes or no, no embellishment here. And I'll just go down and thank everybody as we go through. But the big difference here between this and the last recession was that this was really a health crisis that resulted in an economic crisis. And that unlike the great financial crisis, where our underlying fundamentals were flawed, the same was not true for real estate when this crisis hit. I'd say real estate was strong when we started off 2020. So the question you each have to answer yes or no to is, do you anticipate that by the end of 2021 that your segment of the real estate market will return to the same investment strength, investment level as it was at the beginning of 2020, because our fundamentals underlying were strong and will be back there? So start down the list. I gotta go back in my order here. Tim, capital markets. Yes or no?
Yes. Yes.
Great. Jim Bolt, industrial.
Yes, absolutely yes.
Great. Shane, multifamily. Shane, yes or no?
I'm sorry, I was on mute. Sorry. Zoom. Yes, 100%.
Great. All right, Jordan, multifamily.
Concurrent with the others, yes, 100%.
Eric, land.
Absolutely yes.
Fantastic. Matt, retail, harder.
Sorry to say no.
Lee, office.
I'd say no, but slightly negative.
Okay. Dan.
No.
No. All right. Well, I do feel a little bit like I'm on the Brady Bunch right now with all of us here. Interesting answers. Great. Thank you guys so much for sharing. Really appreciate it. I think that is it for our group. Jema, unless you tell me otherwise, we really appreciate everybody joining us today, all of you sharing your insight and knowledge. And I would say that this is a clear demonstration of why brokers play such an important role to all of us in the real estate community, because you guys definitely have the inside scoop. You have your ear to the ground when things are ever changing on a daily basis, as they are in this market right now. So thank you guys. Congratulations on your awards previously and for sharing today. So
Thank you.
have a great day, everyone.
Thank you, Nicole. Before we drop off, we do have NAIOP's Programs Chair, Brian D., who will just say a few closing words. Thank you.
Okay, there's my dog. He was quiet the whole time.
Thank you again to Nicole and all our panelists for sharing your time and expertise today. We'd like to acknowledge today's program sponsor, Brownstein Hyatt Farber Schreck. You'll all receive a post-webinar survey. Please complete that survey. It helps us improve programs in the future. And visit the NAIOP website at naiop-colorado.org for details on upcoming events and programs. And a recording of today's webinar will also be available on the website later today. Thanks, everybody. Stay healthy.